Good evening, everybody. Welcome to week 8, Accounting 203, summer of 2020. I am your host, Rick Hassey. 3 weeks left, including tonight. I have received most of your quiz number 3 work. I will be posting those solutions and answers tomorrow and Saturday. We're going to talk about 3 chapters this evening. 2 of the chapters, you do not have to worry about journal entries. You just have to know about definitions. So that's a good thing. We're going to be talking about corporate accounting and managerial accounting, what it is. Corporate accounting, we began that discussion last week a little bit, is the difference to account for corporations, especially on the equity side of the ledger. Tonight, you just need to know the definition of corporations and corporation accounting. You don't have to worry about the journal entries. And the reason why I'm not concentrating on the journal entries, because a lot of you are going to be taking a class either this fall or into the next winter called Business Finance 330. And a knowledge of corporate accounting in that class is paramount. You don't need to worry about journal entries. You need to know about how corporations work, how do they distribute dividends, that sort of thing. So we're going to talk about that tonight. Then we're going to talk about chapters 18 and 19, which are about the second side of the street of accounting, managerial accounting. The first basically 7 weeks of our course, we've been talking about financial accounting, the accounting cycle, the adjusting of cash, the adjusting of receivables, payables. That's financial accounting. Now in the latter part of this class, we're talking about managerial accounting. What does this information tell us about our company? Are we efficient? Are we doing things the correct way? What does it cost us to produce our product? Today we had a very sad thing happen in Claremont, where I live. We have an organization in this town that serves a lot of the people of this community. It's a fitness club. It's been here since 1973. And today they announced to the community that they're closing their doors forever. And I know that a lot of companies and a lot of us are running into that these days with this economy and this pandemic. But it hit home a lot to a lot of individuals in this community today, because this organization does a lot to keep the people in this community wellness. And the reason they're closing has to do with accounting. Their expenses were exceeding their revenues, and they couldn't fix it anymore. They got a CARES Act financing from the federal government about 2 months ago, but that money is dried up. They can't open their doors because of the rules of the state for safety and health reasons, and they have no other source of funds. They're closing. And that's a sad state of affairs to this community. And like a lot of communities where you live, Santa Maria, Lompoc, Santa Barbara, wherever, a lot of organizations are closing. This organization was not for profit, and they're closing. Many for-profit companies and organizations are closing. And what a lot of companies are doing now to try to save the corporations or the not-profits, and University of Laverne is one of them, from closing their doors also, is understanding what their costs are. What are fixed and what are variable costs? What are costs that you have to pay out no matter if you have open doors or not? Those are fixed costs. And the greater the fixed costs you have, the more tougher it is to stay open, because why? You don't have revenues coming in to cover those fixed costs. So we're going to be talking about that. That is managerial accounting. What does it tell us about our business? Are we in trouble? Are we doing okay? how do we operate efficiently? But before we get to that, let's talk about the timeline of what your responsibilities are and my responsibilities are over these next couple of weeks. Just so everybody's clear and understand what's going on. This week this is week 8, and we're going to be talking about managerial accounting. You have no graded work this week due. You are working on your project paper. We'll talk more about that in a little bit. But that is due Sunday, August 16th. Next week is week 9. Okay, that's August 6th. This is our last regular class. I would say not last regular. This is our last mandatory class for you guys. And I'll explain that in a minute. Next week, we're going to talk about, again, more managerial accounting, if I can spell it right. There it is. And we're going to have a review, better known as an outline, of what to expect on the final examination. I'll distribute that for class in my introduction video for week 9. That's our topics for next week. Then we have on Saturday, August 8th at 3 p.m. a voluntary review session on Zoom. The link is already posted in your Zoom links and Blackboard. I talked about that a little bit in our introductory video. And what that review session is just extra time for you guys to meet with me with any questions you have about the final examination and the project paper. Any troubles you're having, any frustrations, any issues. Remember, the final examination is not really a final examination. It's an examination on chapters 8 through 11, 13, 18, 19, and 21. So on Saturday, August 8th, we'll be having a review session to go over those chapters. Quiz number 3 was practice for chapters 8, 9, in that area. So that's a special voluntary review session on Saturday, August 8th. I will be recording that review session. So for any of you who should be spending time with your families, or you might have to work, or you just had enough accounting, you don't want to talk more about it on a Saturday, good God. I will record that so you can view it at your convenience later on. Okay. Then we get to our week 10. That's our last official class. And that class is voluntary. You don't have to come if you don't want to, because all I will be doing in that class is also a review. So basically, we have 3 sessions of reviewing any work. If you think you got to handle anything, you don't have to appear at some of these. Week 9 is a beginning of our review. The Saturday, August 8th is a voluntary review session. And the class on week 10, that's August 13th, August 13th, is also review. Okay. Now I will be distributing maybe I should put this in here. I will be distributing the exam the evening of August 6th. You'll have 10 days to complete it. Make that a little bit easier to read here. So I will be distributing the exam in week 9. It's not due the week 10 class, it's due August 16th. So you have 10 days to do it. Making it a little bit less stressful for some of you, because I know you are doing other classes and doing that work as well. Then if you do all that correctly and we go through that process, our class tonight, next week, talking about chapter 21, reviewing the final with an outline, distributing the final examination next week in class. It'll be posted to Blackboard by Sunday, August 16th. We have a review session on August 8th talking about the project paper and the final examination. And then one last review session on August 13th, which is our last official class, just 3 days prior to the due date of that final, if any of you have any last minute issues, problems, concerns. If you do all that correctly, the final grades will be posted Where's my calendar? By Wednesday, August 19th. Now there's a little bit of a but with that final posting of August 19th of your grades. You'll be able to see your final course grade in Blackboard if your course evaluation has been submitted. You should be getting an email from Laverne, maybe you've already gotten it, about filling out your course evaluation for this course. If you have not received it, you will be receiving it pretty soon. And if you complete your course evaluation by Wednesday, August 19th, submitted all your work and I have graded, I will post your final course grade. Now you might be saying, well, Mr. Hasse, what happens if I don't complete the course evaluation? You'll still get your grade. You just won't be able to see it in Blackboard, and you'll have to wait for the registrar to post it about 10 days to 2 weeks later. That's my bargaining chip. If you want your grade right away, August 19th, you fill out your course evaluation. By the way, you should fill out the course evaluation anyways. If you think excuse me, ladies, if you think I stink as a professor, you should tell Laverne about it. If you don't like the course, the outline, the syllabus, the location, whatever, you should let the university know about it. It makes the program better. I always hear from students, oh, this professor stunk. I never knew what the hell was going on. I never got my grades. I don't know what's going on. Did you fill out a course evaluation and let the university know about it? No. It's like voting. Oh, I think our president is a jerk. He doesn't know what he's talking about. Did you vote in 2016? No, I didn't think it was worthwhile. Then don't complain. Then don't complain. If you don't tell people that somebody is not doing their job, or if you tell them, hey, this guy or woman is doing their job, maybe they should teach more classes up here because I like them and I learn. You got to let them know. That's a course evaluation. So if you do all that, you will see your grades Wednesday evening, August 19th.
Are you able to see who submits the evaluation?
No, I can't believe somebody never explained this to you either.
No.
The course evaluation is all anonymous. Nobody knows what's going on. Now you might say, Mr. Hasse, how do you know that I didn't complete the course evaluation? Could you turn off your mic, please?
Yes.
How do I know that? How do you know that I not completed my course evaluation because I just go into my Laverne and it just tells me who has not submitted. It doesn't tell me what they submitted, how they submitted, what they wrote. I don't find that out for 3 months. And I still, when I find out about it, it does not show your names on that at all. It's completely anonymous. It doesn't affect your grade whatsoever. If you don't fill out a course evaluation, that doesn't mean you're not going to get an A. You'll still get an A or a B or an A minus. It has nothing to do with it. It's just feedback to make this university better. And you guys,
Gotcha. Thank you.
and you guys are the reason why I'm here, why we're doing this, because we want you to be better. And if I'm not doing my job, you got to let somebody know about that. If I'm doing my job, you let somebody know about it. Because then it won't get any better for you. That's important. You guys are paying good money to be in this thing. You need value. If you're not getting that value, you have a right to share your opinions anonymously. Nobody knows who you are. And let me show you how these evaluations work. When they are all completed, a set goes to President Lieberman, and she reads them. Trust me. A set goes to the provost, to the dean of the College of Business, to my boss, the assistant dean, and a set comes to me. Now, I don't get the set until see, this course ends in August. I don't get the set probably till the beginning of October. But I get it, and it's important to me to see how I did my job. Very important. And so that's why that's important. Okay, that's the end of my Chamber of Commerce speech for that. But if you don't like the program, you like the program, you think the program could be better, fill out an evaluation. And you do that, you'll get your grade 3 days after you posted your final work. Not a bad deal, if you ask me. Okay. Now, one last thing in regards to grades, and I will know this in about a week, but I was wondering, and you don't have to tell me this is a personal matter, but in the summertime this year, you have the option of either getting a letter grade in this class, A, B, C, D, E, A, B, C, D, F, or you can get a NR, a no grade that just says you passed the course. It's like pass, fail. Now, so hopefully somebody has told you about that weeks ago and you signed up for that option. If you have, this is the first time you're hearing about it, it's too late anyways. That's the duty of your academic advisor, where you can opt to take this course for just a pass-fail. Some students opt that in the summertime because, and also that was available last spring when we were doing the first online courses, because some students just, this is a new experience for them and they said, okay, I'll just, I'll just take this pass-fail. Now, if this is your major, you don't want to have too many pass-fails in your transcripts because then you don't have a grade point average. So you got to think about that, and you should talk about that with your academic advisor. Sometimes when I'll be frank, sometimes when I see some students not attending class, the first thing I think about is, oh, they're taking this class pass-fail. They'll just do the work, try to get a B, C, maybe an A, but their grade will be pass. They won't get a letter grade because they've opted not to do that. That's fine by me. I did that a couple times when I was in college. So you have that option for this class, and hopefully you know about that. If you don't know about that, get on the blower to your academic advisor tomorrow or send them an email. Okay, so that's our timeline. And I go through this the 8th week of every class just so everybody knows what the hell is going on. Grades will be posted August 19th. Adios, amigos. Maybe I'll see some of you again in business finance. Maybe I'll see some of you again in graduate school. Maybe some of you I'll see again at Bravo Pizza in Lompoc. You never know. Or maybe I'll see you again at Oso Libra Winery over by Santa Maria. No, not Santa Maria. Paso Robles. I like that winery. Okay, does anybody have any questions on this timeline or what are our things that we are going to be doing? Any questions here?
I just had a quick question.
Sure, Jessica.
I'm sorry to be, if I'm distracting anyone, I'm just trying to cook dinner.
What's for dinner? Hold it, time out. What's for dinner?
Homemade lasagna and salad.
Could you freeze that and send me a little bit Federal Express? I'll give you my credit card. You can send that to me?
Of course.
I'm teasing. All right, your question, Jessica.
So basically the only things that are mandatorily due is the paper and the final from here on
Exactly.
out. And okay, cool.
That's it. That's
Okay.
it. You have the paper. You've had that for a few weeks. The final, you'll get an outline of what the final is made up of next week or before next week's class in my introduction video. And I'll probably send that to you on Sunday of this coming weekend. And
Thank
then I will distribute the final examination in class next week. You have 10 days to do it. Or if you, now, now I'm not going to be embarrassed, but Bianca has already posted her paper. So I'm going to be grading her paper this weekend. She's got her work done and posted. So if you post as soon as possible, you'll get your grade. So some of you, if you clean that up early, you do your course evaluation early, I will post your grade well before August 19th if you have everything completed. But if you take the time allotted, which you should, to do your best work if you need to, this is the timeline we will use. Okay, Jessica?
Awesome, thank you.
Good luck cooking. Are we putting meat in our lasagna or non-meat?
Always. There's carnivores only in my house.
Thank you very much. All right. Any other questions in this regard?
I do.
Okay. Then I'll save this and post this to Blackboard after our class.
Mr. Hassey, I have a question.
Hold it, I can't hear you. I can barely hear you, whoever that is.
Blanca,
Blanca, I can barely hear you.
I don't know what to do. I have it in high volume. Okay, I'm gonna give it a shot.
Now I can hear you.
Okay. Oh, you left. I think it was week 10. Can we ask relevant questions in regards to the final?
Well, the definition of relevant is if it's about a definition or a topic in the final, in the questions, yes. But if it's specifically related to a question about helping you solve the specific question, no.
Okay, no, that's good enough.
Yeah.
That's fair. Thank
Okay.
you.
Thanks, Blanca. Good question. Lisa Barlow. Oh, here. Okay. Any other questions in this timeline regard? Now, here's another thing that I want to warn you. The reason I'm giving you 10 days to do the final is because there's no extensions. Everything has to be posted midnight, August 16th. I have to get the grades in. I want to take a little bit of vacation after this class. I want to get the hell out of here. So I don't know where the hell I'm going to go yet. Depends on the pandemic. But I might come up and, hang out at Jessica's house as long as she's going to make more lasagna. Or I might hang out at Blanca's house just to check out her bed. I feel like I know it. Or whatever. But so there's no extensions. August 16th is the last flat out day I can have the postings of your paper and the exam. I can't get an email that literally you can see the tears on the email saying on Sunday the 16th, Mr. Hassey, can I have another day? I'm not going to make it. Sorry, I warned you on July 30th about that. You have August 16th. I can't give any more extensions because I got to get the grades in. I think that's plenty of time. You'll be okay. Any other questions in this regard? Cool. Okay, so we're all set. It's documented. You know exactly what you have to do. If you feel you don't want to come to class next week, you got this thing covered and you can just live by my postings in Blackboard. You don't have to come to class. I take attendance every class because I keep track of this. It tells me a little bit about your efforts. But next week, I will not be taking attendance. I will not be taking attendance in week 10. It's, you know, if you don't want to come, you don't want to come. You want to just stay home and concentrate on your work, that's fine. Or concentrate on other classes, that's fine. I'll be here. I'll record every session. No worries. That's the good thing about that. So just so you know, you got plenty of time to figure this out, plenty of time to see me. We got 3 review sessions. Plenty of time to answer any unknowns. Okay, great, good job. Cynthia Harbo, how are you tonight? Is your computer working okay? No strangers visiting you?
It's a long story.
All right, well, we'll save that
For another time. Yeah.
It'll
Well, thank
probably
you
be
for asking.
it'll probably be a motion picture one of these days.
Oh, yeah, definitely.
Okay, good. Well, I'm glad you're smiling. That's good. All right, let's take a look at corporate accounting here. One moment, please. And we talked a little bit about this last week, but I want to go over the highlights again. Because you're not going to be responsible for any journal entries, any financial statements, none of that. It's just understanding the definition of corporations. That's important. So let's bring this up. Okay, here we go. We've had a couple of earthquakes down here in Southern California today, 4.5 and a 4.2. So things are kind of rocking and rolling down here. And I was a little bit concerned because my internet service went off a little bit this morning, early in the morning because of the earthquakes, but it's been working very good. So if all of a sudden I start going like this, you'll know what's going on. Okay. Okay. A corporation can be privately held or publicly held. Okay. Privately held or publicly held. I'll give you an example. A privately held corporation was Facebook about 10 years ago. Facebook was a private corporation owned entirely by Mark Zuckerberg and the people who privately invested in him to start his business. That's a private corporation. All right. You don't have to show anybody anything. Everything is private. But then in order to get greater money, greater capital, in other words, going public is selling the stock of the company to the market. You sell your stock to the world, where Michelle, Jessica, Cynthia, Blanca, all of you, Ashley, could buy stock in a company that's going public. You're investing and you're giving your money to them to become bigger and better. That's what Facebook's done, Apple's done, that's all these companies. And that's called being a publicly owned corporation. And when you're a publicly owned corporation, you have to do what you're all doing in your paper, look at a company's 10K. Every public corporation has to file an annual 10K financial report. And as a lot of you have already seen, 200 pages, 300 pages. What the hell is all this stuff? It's monstrous. All right. But you have to do that. But if you're a private corporation, you don't have to do that. You don't have to. You keep it private. You don't have to have anybody do anything. All those companies, if you're watching Shark Tank, you ever watch Shark Tank on CNBC? Shark Tank are all private corporations. Private. They're looking for private financing. Now, a couple of those companies over time have gone public, gotten bigger. But almost every one of those are private corporations. But we're more concerned about publicly owned corporations because when you go to business finance, you're going to be studying publicly owned companies. What are the advantages of being a corporation? You're a separate legal entity. The corporation is a separate vehicle. Example, if I'm when I was in business, I had a private corporation. I owned the whole thing. All right. But here's the bad thing about, and this is one of the disadvantages of being a private corporation. If I'm a private corporation, my personal finances were also part of my corporation finances. They're one and the same. When I filed a tax return, it was my personal tax return at the same time my company tax return. They weren't separate. In a public corporation, they're separate. Who are the owners of a corporation? The stockholders. You don't have to report Apple's sales on your personal tax return. Thank God. No, that might be a good thing. They're separate. Okay, that's a key thing. They're separate. A private corporation, they're together. Another key point of a corporation is these two words: limited liability. That might not mean nothing to you, but it means you can't get sued. Here's what this means. If I own a private corporation and Michelle comes into my business and trips and falls in my store and hits her head and has a concussion, because I'm a private corporation, if Michelle sues me for her injury to get reimbursed for her injury, if Michelle sues me because she can't go to work because of her concussion, because I'm a private corporation, she can sue me, Rick Hassey. She can go after my assets, my house, my car, my money, also the company's money as well. She can, because when she's suing the company, she's suing me. But if I was a public corporation and Michelle came into my business and tripped and fell and got a concussion and sues the company, she sues the entity, the company. She cannot sue me, who's running the company. She can only sue the assets of the company. She cannot sue the assets of the ownership of the company. That's called limited liability. Now, granted, if you're a corporation, you probably have a lot of assets. So Michelle can still win and get a substantial amount of money. And even if the company doesn't have a lot of assets, the jury could award huge damages because the company was screwing up. That happens. Just ask the cigarette companies that. All right. But limited liability, that's why almost all doctors' offices today are LLCs, limited liability corporations. Malpractice. If you sue a doctor for malpractice, in the old days, 15 years ago, you could sue the doctor and take his or her money. But nowadays, you can only sue the practice, the corporation, the assets of the doctor. Same thing with law firms, public accounting firms. They're all LLCs or LLPs, limited liability partnerships, corporations. That's a key. That's a huge thing. If any of you are going to start a business, one of the first questions somebody will ask you, are you going to be a private entity or are you going to be a corporation with stockholders or owners? Now, when you're first starting a business, probably not. You're just going to be private. But as you become successful, you're probably going to have to eventually become a corporation with limited liability. It's a big deal. Another advantage of being a corporation is you can transfer ownership rights. If I'm a private corporation and if I have the company in my name, the only way I can cash out of the company is selling it. But if I'm in a corporation and I own stock in a corporation, I can sell that anytime I want, as long as somebody's willing to buy it on the New York Stock Exchange. I can sell it at any time. So you can transfer ownership all the time. With a private corporation, it's very difficult to cash out. That's why Facebook went public. Mark Zuckerberg and his investors wanted to cash out a little bit, get a little money out of their business for their efforts, and sell their company to the public stockholders. A corporation has a continuous life. It's always going to be in existence. Yes, corporations close, but it's run under the assumption that it will always be there. The disadvantages of corporations, as you can see in this slide, are two. Government is always looking under your hood to see what's going on. Government regulation. And you're taxed. Corporations are taxed twice. Once on their profits. Twice, once they pay tax on their profits, then they distribute whatever's left over to their shareholders as dividends. When they distribute those dividends to the shareholders, that money is taxed by the government on the shareholders as income. So corporate profits are taxed twice, once at the corporate level, and secondly, when you distribute the dividends to your ownership. That's why so many corporations have lobbyists to change tax laws to limit their tax liabilities by passing certain deductions. And if any of you are working for a corporation in HR, human resources, or accounting, or maybe in the legal counsel office of a company, you know there's tons of government regulation. You always have to file reports on your employees, on your pollution, on your diversity, on everything. If you're a public corporation, you have to file these reports. It's required by law. Why? It's protecting the public who owns your corporation, making sure they can trust that their stock is worthwhile owning because your company is doing the right things in managing their business. Private companies don't have to worry about that. They still get taxed, but they have very little government regulation. Public corporations do. The organization of a corporation is very important. I work for a company. I'm at the bottom of the pyramid. The management team, the people who make the strategic decisions, which some of you already are at that level or will be at that level in your career, that's the next level. And they report to the board of directors. The board of directors represents the stockholders of the company. The stockholders vote for the board of directors, vote who places on them. Usually they're stockholders themselves. The board of directors hires the management team. The management team hires you and I. The stockholders run the show. They're the owners. The stockholders select the board selects the management picks the rest of us. That's called corporate governance. When somebody said, it'd be kind of cool one day to go into your HR office or into your company you work at and tell me, what's our corporate governance? What's our pyramid? Who reports to who around here? Is there a depth chart? Is there a chart showing me who reports to who? You'd be surprised how a lot of people don't even know who in the hell works where and what and who for who in a company. That's a good question to ask. Who works for who in this organization? What's the pyramid? It's called corporate governance. That's an important quality of a company. Who runs the show? And if you're a stockholder in the company, and most of you know this because most of you are stockholders. In some cases, you're stockholders and you don't even know it. If you invest in a 401k plan at your work, if you put money into the bank, many times banks will take some of your money and invest it in stocks. You don't know this, but the bank does. Yes, you're guaranteed your money in the bank, but the bank takes your money and they invest it too. As a shareholder or a stockholder in a corporation, you have rights. You can vote to determine who's on the board. It's called a proxy vote. As a stockholder, you have a right to vote who should be running the company. You have the right to sell the stock at any time you desire. You have the right to purchase any additional stock if you can afford it at any time. You're entitled to any dividends if they're declared by the company to get a check on your holdings of the company. And if the company liquidates, closes, shuts down, you get a share of the liquidation if there is any. Usually there's not much because they got to pay the debt first. But usually if a company closes, you get what's left over. That's your right as a stockholder. When you go out and buy Tesla stock for $1,100 a share, you now have the right to attend a stockholders meeting and tell Elon Musk what the hell's going on. Now, I don't know if he's going to listen to you, but you have that right. You have the right to tell Jessica not too much sauce in the lasagna. Keep it light. She's not even listening to me. Jessica, what's your husband's name?
Bobby?
Bobby, how you doing tonight?
What's going on?
My name's Rick. Nice to meet you.
Nice to meet you. I just got done painting a bedroom.
What color?
It's garden rose white.
Who's gonna live in this bedroom?
It's in her family's house. I got voluntold.
Did they reimburse you for this experience?
My mom watches our son almost every day.
Oh,
So we
okay,
have free daycare. So I
there you
told
go.
him that's
Up with
free.
get out the paintbrush. Yes.
Yeah.
Okay, thank you. Nice meeting you.
Nice meeting you too.
Okay, so those are the rights of the stockholders. It's important. Here's a stock certificate. If you buy a stock, this is kind of what it looks like. Do you realize that the Green Bay Packers football team is a publicly owned company? So are the Los Angeles Dodgers, the Atlanta Braves. Who else? The New York Knickerbockers. This is a share of stock in the Green Bay Packers. I owned Green Bay Packers stock once, but it was lousy. I got rid of it. This entitles you to tell the world you have stock in this company. You transfer this certificate to whenever you sell the stock to whoever you do, stockbrokers. They handle these transfers for you and take out a fee. That's what a stockbroker does. When a company incorporates, in other words, if you become a corporation, and in most American corporations, does anybody happen to know what state in the United States where most corporations are incorporated in? The state is Delaware. Delaware. Why? It's cheap. To incorporate a company is expensive. You got to pay a lot of fees. Delaware is the cheapest. That's why a lot of corporations are incorporated in Delaware. They can work anywhere they want, but they're incorporated or set up in Delaware. It's cheap. And when you incorporate, you are authorized to issue a certain amount of shares to raise capital. And when those shares are issued, they are given a par value. That's the value that goes in the accounting records. So let's say a company issues 92,556,295 shares of stock. They can issue up to 250 million, but they've only issued 92.5 million up to this point. On their balance sheet, under common stock would be that number of shares times a penny. And that's the credit to common stock. Again, you don't have to worry about the journal entries here, but that's how it would go on the books as par value. It's kind of like an arbitrary value to the stock. Doesn't mean in the market it's going to be sold for a penny, probably be sold for a lot more. But on the books, that's the issuance value, the par value. Oops, excuse me. The par value is the book value, the accounting value. The market value is the price that the stock will sell in the market. This company has a par value of 1 cent. But if you go to the market and say, I'd like to buy this company's stock, you might have to pay $10 for it. That's what the market says it's worth. So the company's going to get 10 bucks. The additional, on the books, it's only booked at a penny. The additional money is called paid in capital. You don't have to worry about that. Just know the difference between par value and market value. That's important. Three types of equity in a company. Common stock, paid in capital, retained earnings. You need to know these three because there's going to be a question on the final examination exactly about this. So I'm giving you advance warning. 3 ways that equity can be shown on a financial statement for a corporation. Up to this point in time, when we were doing our problems in the accounting cycle, equity was in the form of capital. That was it, capital. Profits went in the capital, investments by the owners in the capital, withdrawals out of the business, capital. One account. But now in a corporations, there's 3 accounts. Excuse me. The book value of the stock, the par value, is 1. The additional money they receive over the par value at market is called paid in capital. And the retained earnings is where you close the books. You close revenue and expense and dividends to retained earnings. That's where you close your books. Before we did our closing entries to income summary, and then they ended up in capital. For a corporation, you still close them to income summary, but then you close it finally to retained earnings. That's the cumulative profit you keep year in and year out once you distribute the dividends. Those are 3 important things about a corporation besides the definition. The equity is common stock, paid in capital, retained earnings. Now we're going to get into journal entries, and we don't want to worry about that. Let me jump ahead. One other type of stock you should be familiar with in a company. Let's get this definition for you. There's 2 types of stock in a company. There's common stock, which is the majority of stock in the market. And then there's called preferred stock. Preferred stock is just like common stock, but you cannot get a dividend. There's no dividends for preferred stock. The preferred stock has guaranteed dividends in the stock price. And I'll explain that in just a minute. In other words, if I buy a common stock for 10 bucks, the company every quarter would say, okay, Mr. Hassey, we're going to pay you $1 dividend this quarter for owning that stock. They write me a check for $1, I get a dividend. If I have preferred stock, when I bought that preferred stock, let's say for $20, the preferred stock said you will get a $2.50 dividend every year, no matter what. Preferred stock has guaranteed dividends. You know exactly what you're getting dividend year in and year out. It's part of the stock. Whereas common stock, you buy the stock, you have no idea what you're going to get in dividends. The attractiveness of common stock, it goes up faster in value than a preferred stock, because a lot of people buy preferred stock and they're not going to sell it. They're buying it to get the $2.50 dividend. And it's stated right on the stock. The downside of preferred stock is you have no voting right in the company. No say. Preferred stock is almost like lending them money. It's like credit, because you're going to get a guaranteed payment every year on what you gave them. So there's no voting rights, and you get a guaranteed dividend. Where common stock, no, you have voting rights, but no guarantee of dividend. You're taking a guess, a hope. That's the difference. Now, not many companies issued preferred stock because it's expensive. They know that they have to pay a dividend no matter what. If the company makes money or loses money, they still have to pay a dividend. This quarter, a lot of companies aren't paying a dividend because they're losing money. So there's no dividends this quarter. But if they had preferred stock, they got to pay a dividend. So a lot of companies don't issue preferred stock. The only companies who issue preferred stock are the regulated companies of the world. Utilities. Utility companies issue preferred stock because they're regulated by government on the fees and revenues they charge to their customers. So the government says, okay, because we're regulating you, you're allowed to issue preferred stock and pay guaranteed dividends in lieu of that, because we're regulating you. Utility companies issue preferred stock. And when you see a company like Ford Motor Company or Apple Computer issuing preferred stock, that means they're in trouble. Why? Nobody wants to buy their common stock, and no banks want to lend them money, so their only way of getting capital financing is issuing preferred stock with a guaranteed dividend, and that's expensive. In 2008, when the economy was collapsing, kind of like today, Bank of America was about ready to close. Bank of America was hours away from shutting down and not making your checking accounts accessible to you. Very close. And you know what saved them? Warren Buffett. Bank of America went to Warren Buffett and said, Warren, we're about ready to close. Can you give us $1 billion? Well, Warren Buffett is no idiot. And he told Bank of America, sure, I'll give you the $1 billion so you can stay open. But in return, I want to own preferred stock. Oh. So Bank of America had no other alternative. They paid Warren Buffett, or they took Warren Buffett's $1 billion, but also at the same time, they issued preferred stock to Warren for $1 billion and guaranteed him 10% every year of that $1 billion as a dividend. So every year, Warren Buffett gets a check to this day from Bank of America for $100 million. Well, this was in 2008, so that's 12 years ago. 12 times 100 million is $1.2 billion. Warren has got his money back, and it's all profit now on his investment in Bank of America because they gave him preferred stock with guaranteed dividends. Not too shabby for Warren. Okay. That's our definitions of corporate accounting, of stock, of equity. We need to be familiar with those definitions. The PowerPoint is in Blackboard, but you need to concentrate on, if you took notes, it's also in Blackboard on those highlights. When we come back from our break, we're going to talk about cost classifications, cost accounting, a little bit different way of looking at numbers. When we come back from break, chapter 18 and 19. Remember, managerial accounting is the study of how efficient you are in determining what it costs you to produce a product. Not how you account for it, what's the definition of certain costs and numbers. and we'll be looking at that after our break. So let's take a break. There'll be a little poll on the break when we come back for you to answer if you'd like. And I'll see you all back in about 10 minutes. Thanks, everybody. We'll see you then. There we go. So we have a poll this evening, week 8, Accounting 203 poll. The question is, a 10K financial report is required by whom? Public accounting firm, corporation's board of directors, Security and Exchange Commission, the National Football League, the state the corporation is incorporated. Who requires a 10K financial report? And if you all remember, the 10K financial report is the report that you're reviewing on your selected companies, answering those questions for your project paper due on August 16th. So let me give you 45 more seconds for those students who have yet to answer this poll. Again, this is a fun thing. It's not a big deal. A 10K financial report is required by whom? So here are the results. 84% of you answered this question, and the correct answer is the Security and Exchange Commission requires the 10K report to be filed with them for public viewership in the markets. Now, the corporation's board of directors, this is a requirement as an corporation in the United States to file a 10K with the Securities and Exchange Commission. So the corporation's board of directors hires a public accounting firm to put this together. A company provides the information from their accounting records and their financial records, but a public accounting firm files and prepares the 10K report for an awful lot of money with the Securities and Exchange Commission. So the Securities and Exchange Commission requires it. The board of directors know that it's required of their incorporation, so they hire a public accounting firm to prepare it. I wish it was the case, but the National Football League is not associated with this 10K report. Speaking of sports, if you look behind me, the Lakers are up about 10 on the Clippers in the first half of the first game of the NBA this restarted season tonight. Lakers up by about 10 in the, I think it's now the second quarter. A lot of sports on tonight. Lakers, Dodgers, Angels, hockey, but accounting is the #1 priority. So there's our poll for this evening. If you go to your 10K report, you'll see the public accounting firm that prepared that report for the company. Free Joe Kelly, says Elijah. Joe Kelly got what he deserved, but still was great that he did it. Thank you, Elijah, for that sports commentary. Okay, so that's our poll for this evening, kind of related to our project paper. Good job, everybody. Aubrey, did you get the poll correct? All you have to do is give me a thumbs up. All right, very good. Is your family now out of town? Everything is okay?
Yeah, they just made it. Massachusetts had actually just implemented a quarantine if you were flying around. So they got home just in time.
Good.
So.
That's good. Okay. Managerial accounting, chapter 18. Okay. As I indicated earlier at the beginning of the class, there's two types of accounting, and that's why this course is entitled Financial and Managerial Accounting. Financial is the actual recording of business transactions, which you all have successfully done through your midterm. Successfully recording business transactions and putting them into financial statements to show the world what happened. Managerial accounting is taking this information and providing managerial assistance about costs of products. Are we profitable? Are our customers satisfied? Managerial accounting takes a look at what the numbers tell us about our company's efficiency. Here's a great slide in chapter 18 that you should pay attention to. It's the differences in the highlights of financial and managerial accounting. And a couple of lines to pay particular attention to. The purpose of information. Financial accounting helps external users make investment, credit, and other decisions based on the financial data of the company. Whereas managerial accounting helps managers within the company make planning and control decisions. And that's the main reason, the difference between financial and managerial. Financial accounting is for external people, resource users, external. Managerial accounting is for internal managers. When some of you might work in departments or be managers of departments, and you get a budget sheet every month, how you did to actual in your department. And then there's another column called the difference or the variance. That's managerial accounting. It's not a financial statement. It's not income statement. It's not a balance sheet. It's an internal statement to tell you how you did in your department, budget to actual. That's managerial accounting. The time dimension of this. Financial accounting is what happened, past. What did we do this last year? What did we do last quarter? Financial information on the past. Managerial accounting is using this information to determine the future. Projections and estimates about what we think we're going to pay or cost us to run the company. The past data of financial accounting helps us to determine future decisions, and that's managerial accounting. Give you an example. About 2 months ago, the University of Laverne closed their financial records for June 30th. And they got their financial information. How'd we do? What happened? That information was given to certain managers at the university who used this as managerial accounting information to determine, okay, what are we going to charge for tuition next year? How much are we going to pay our professors next year? How much scholarships are we going to give next year? That information of the past in financial accounting helped us make decisions for the future in those examples. Every company does that. Using what happened to what we do next. What we do next is managerial accounting. That's a great definition of that as well. And the nature of the information, number 7. All the financial accounting information is in dollars, monetary. Dollars. But managerial accounting is monetary, dollars, but also non-monetary. Example, variances, differences between budget and actual, percentages. We are at 100% of budget, or we're at 90% of budget. Percentages are used a lot in managerial accounting. Also, how many units or how many credit hours or how many products did we sell in numbers last year? I can't go to the financial statement of Apple and say, oh, where does it tell me about how many computers they sold last year? That's not in the financial information, how many computers they sold. But if I go to the managerial data, it'll say, oh, this is how many computers we shipped last year. Ah, thank you. So that's non-monetary. It's other information that's related to the financial operations. So 3 bits of data that are very important in this definition. Number 2 in this chart, purpose of information. 5, time dimension. And 7, the nature of the information. I want you to be familiar with that. Okay. Now, we're going to do a couple of problems in this regard to understand these definitions. But in managerial accounting, we now have what are called cost classifications. Up to this point in time, when I mentioned an expense or a cost, you said wages, supplies, utilities, insurance, depreciation. Those are expenses. In managerial accounting, we call them either fixed or variable. Because remember, managerial accounting doesn't do financial statements. The financial statements show wage expense, depreciation expense, that sort of thing. But in managerial accounting, remember, this is for the internal managers of a company. What are our fixed costs and what are our variable costs? So that list I just gave you of wages, insurance, depreciation, utilities, those are either fixed or variable costs. So managerial accounting is understanding what is a fixed cost. A fixed cost is the same amount of money no matter what the activity. Here's an example of a fixed cost. I manage a department. My department produces a widget. But as a manager of a department, I get paid a salary, $50,000 a year. That's my salary. If I produce 100,000 widgets or 1 million widgets, I still get paid $50,000. That's a fixed cost, a salary. No matter what the level of activity of my department or what I did, I still get paid $50,000. That's the definition of a fixed cost. The activity level means nothing. A variable cost is the opposite. Using that example of the company and the widget. I manage a widget department and I get paid $50,000. But we make widgets. So I have 2 costs in my widgets, labor and materials. With the labor, I take the materials and produce a widget. Labor is paid at $20 an hour. Materials are $30 per widget. The more widgets I produce, I'm going to have more labor and material costs. If I produce less widgets, my labor costs and my material costs will go down because I'm producing less. That's a variable cost. The total dollars change with volume, whereas fixed costs, the total dollars do not change with volume. So these are the 2 main points of Chapter 18. The definition between financial accounting and managerial accounting, and the difference between Now we see expenses put into two categories, fixed and variable. Another explanation of fixed costs, which some of you might run into your businesses and your jobs, is fixed costs could also be considered overhead. Overhead. Okay? Let's take a look at this class, Accounting 203 for Laverne. What's a variable cost? Professor Hassey. The more hours I teach, I get paid more. I do have a contract with a certain amount of hours I do not exceed. But in some cases, during some weeks, I see some more students in office hours. I help students out a little bit more in some other sessions, so I have more hours. They have to pay me more. What's a fixed cost for this class? Your academic advisor. They're a fixed cost. Why? You can see them as many times you want or don't see them at all. They still get paid the same amount. That's a fixed cost. See the difference? So where companies try to control costs, like now, they can do it two ways. In variable costs, they'll say, Mr. Hassey, we're cutting your hours. What? How am I going to be able to teach my students and give them value? I don't care, figure it out, but we're cutting your hours. Or another way to cut costs is tell the academic advisors, we're cutting your salary and paying you less. So I don't care if you see a lot of students or don't see any, you're going to get paid less. And volume has nothing to do with it. Variable cost is, Mr. Hassey, we're cutting your hours, you can't teach that much. Very important definitions in managerial accounting. That's how companies lay off people. How do they attack it? The first thing they look at is, how many people can we lay off? Because if we lay them off, that means we don't have to pay them at all. They're not working. They're a variable cost. But if I lay off a supervisor or an academic advisor, if I lay them off, I'm saving all that salary. And it doesn't really influence the quality of the class. It's a little bit different. And it depends on how companies treat this. At Laverne, I'll just tell you this right off the bat. This summer and this spring, when we went to online learning, they told the faculty, if you need to work overtime and extra hours to make the students learn and be comfortable, do it. So they're paying us overtime. Not me.
Nice.
No, not me, but a lot of other people. But you know what they also did? They laid off and furloughed fixed cost salary people. They laid them off or furloughed them. What's the difference between a layoff and a furlough? Depends who you ask. A layoff means we're laying you off and there's might be a chance you can come back, but very little. A furlough means we're kind of trying to commit to have you come back.
Maybe.
But that's how they do it. And a lot of companies are doing that these days. What type of cost are you? Fixed or variable? If you're a salaried employee and volume means nothing to your way you get paid, you're a fixed cost. Aubrey, are you a fixed or a variable cost? You don't have to answer that. I'm just being, that's too personal. Don't answer that. But I'm a variable cost. I get paid on hours. President Lieberman is a fixed cost. Whoever your academic advisor is a fixed cost. That's how it works. Need to know that definition. So let's look at a problem that practices this, because you're going to get one like this on the exam. Let's take a look at this. I'm going to chapter 18. If I can find it. There it is. Problem 18.1a. I don't know what page that's on. Sorry, I don't have that here. Oh, yes, 679, page 679 of your textbook, problem 18-1A. We're now going to go around the room. And for example, the very first one here, note it says plastic for casing. Here are the total costs associated with the production of 1,000 drum sets manufactured by TrueBeat. The drum sets sell for $500 each. And here are the various costs associated with this. Our job is to determine variable or fixed, product or period. Okay, now let me explain product or period. Variable and fixed we just went through. Variable are costs that are affected by volume. Fixed are costs that stay the same that are not affected by volume. What's a product cost? A product cost is a cost directly associated with what you're doing. A drum set. Is this expense or cost part of the manufacturing of your product? A period cost would be a cost that is not associated with the product. It's a period cost. And we'll see that as we go through this. So notice, the first cost is plastic for casing, whatever that is in a drum set. And notice I put that under variable. The more drums we produce, the more costs we're going to have, right? And it's a product cost. It's directly associated with the product of the drum. Okay? I'm going to do the next one as well. Wages for assembly workers. Wages for assembly workers. That would be a variable cost. Right? A variable cost. And it would be a product cost as well. Why? Because it's direct wages for assembly workers. The assembly workers are producing and putting together the drum sets. That's a product cost. Variable and product for the first two. I'm not going to fill these in. I'll let you guys do that. Now here's the next one. Who's somebody I don't hear from very often? Mr. Woolsey, come on down. Turn on your microphone, Mr. Woolsey. Mr. Woolsey. Hello.
Hello.
There you are. Mr. Woolsey, how's it going this evening?
I'm good. How are you?
Good. Anything exciting going on in your life now you want to share with us?
Nothing really.
All right, join the club. All right. I'd like you to tell me the next one on our list here. Property taxes on the factory are $5,000. Property taxes on the factory where you're producing the drum set. Variable or fixed, product or period. What do you think?
Would it be fixed with period?
Excellent. Nope. Product.
Product.
Because the factory is where you're making the product, right?
Yeah.
But you're exactly right with the fixed. Property taxes. They have nothing to do with how many drums you produce. Very good. So the answer to number 3, thanks, Jager, I appreciate it.
Yep.
Jager says property taxes on the factory are fixed and product. The key determination there for product is the factory is where you produce the product. Okay. Lisa Barlow, come on down.
Okay.
Hi, Lisa. How you doing tonight?
Doing okay. Doing okay.
Anything exciting going on in your life you want to share with us?
No, nothing exciting's going on.
Join the club.
Nothing
Okay. Lisa, you're here to answer me variable, fixed, product, or period for accounting staff salaries.
Fixed and period.
Excellent, Lisa. Thank you. Fixed, it's a salary. We've talked about that. And period, because the accounting staff has nothing to do with the production of the drum sets. It's a period cost. Thank you, Lisa. Well done. Good to hear from you. Mr. Diggins, Elijah, come on down.
So number 5, correct?
Number 5, drum stands, 1,000 stands purchased, variable, fixed, product, or period.
Is it a variable cost over a product?
Excellent. Very good, Mr. Diggins. Good job. Variable and product cost. Exactly right. The more drum stands we buy and for our drums, the more cost. It's a variable. And it's a product cost. Without the drum stands, we don't have the product. Very good. Thank you, Elijah. Maribel. Come on down, Maribel.
Okay, so
Maribel has number 6, rent cost of equipment for sales staff. Variable, fixed, product, or period.
fixed period.
Excellent. Maribel, you are sharp. Even though I'm just seeing your picture all the time, it's a nice answer. Very good, Maribel. Rent on equipment is fixed and period. Nothing to do with the product. It's a sales team. And it's fixed. It's rent. Has nothing to do with volume. Thank you, Maribel. Cassandra. Cassandra, welcome to my world.
Hello.
Hello, Cassandra. Upper management salaries, variable or fixed, product or period?
Let's see. Variable and period.
If I'm paying somebody a salary.
Oh, sorry, fixed.
There you go. Very good, Cassandra. Upper management salaries are fixed and period. Why? Because they're upper management. You don't see the CEO down there producing the drums.
Nope.
So it's a period cost. Thank you, Cassandra. Very good. Joel, Mr. Wadlow. Welcome to my world. Number 8, annual flat fee for factory maintenance service. Variable, fixed, product, or period?
Would it be? Oh my gosh, I don't know.
Well, if it says annual flat fee, what does that tell you?
It's an annual flat fee. I don't know. Would it be? I'm scared. Is it gonna be? Would it be? Is it variable product?
If it's an annual flat fee,
Wait,
that means I'm going to pay that.
No. Wait, is it a fixed period?
It's a fixed, but what it says here, remember we talked about this earlier in number 3, it's an annual flat fee for factory maintenance service, where we're producing the product, fixed and product cost.
So then it would be a fixed product?
Yes, sir.
Okay.
Okay? All right, Joel, why don't you do the next one too?
No.
Sales commissions are $15 per unit. So if you're in the sales team, for every sale of the drum, you get $15 as a commission. Variable or fixed, product or period. If you're a sales commission, $15 a unit.
that would be a variable product.
If it's silent, you know you're wrong.
Oh my gosh, wait, okay. Variable period.
Very good.
There we go.
Good job, Joel. Variable because it's 15. The more units you sell, you get more money. Variable, but it's a period cost because it has nothing to do with the production of the product. It's a sales commission. Okay?
Okay.
Good job, Joel. You're done for the night.
Thank the Lord.
Okay. Jessica Murray, the lasagna is done. Everybody is happy in the Murray household. The room is painted. The kids are now with their dad and he's dealing with them. We now can concentrate on managerial accounting. Jessica, number 10, machinery depreciation, straight line, variable, fixed, product, period.
Well, I see depreciation, and I know that can kind of fluctuate, but when it says straight line, that's where I'm getting confused. I would say variable product.
If we're paying straight line depreciation, $40,000, no matter how many units
Fixed.
thank you.
Yeah, fixed product.
Fixed product, exactly right. Very good. Very good, Jessica. Thank you, Jessica. All right. So those are all pretty good definitions of these classifications. Notice these are all different types of expenses in a company, and we've seen those before. But now in managerial accounting, we put them in a category that tells us something about the nature of the cost. It helps us understand it. Variable, fixed, product, period. You're going to see a question like this on your examination. Always you got to think about them a little bit, just like what Jessica just did. Machinery depreciation straight line, okay? That means it's going to be the same amount all the time. Fixed, and it's machinery. That means the machinery is producing the drums. It's a product cost. Excellent. Well done. Now, if you would like to practice, I would like you to do on your own. The solutions are in Blackboard. If you want to practice this as a study guide, look at 18.2a, the one right underneath it, or one at the top of the next page on page 680. It gives you, again, sample cost. What of these are product or period cost? Okay. Do not worry about materials, labor, and overhead yet. We talk about that next week, okay? We'll talk about that next week. All right, so managerial accounting is kind of giving us new things to think about, as if you guys want that. Go, oh, Mr. Hassey, really? More? But it's showing accounting numbers in a different light. It's telling us about something about the cost. Does it change or does it stay the same? Is it attributable to the product we're producing and selling, or it has to do with administrative expenses? Remember, what are the period costs in this problem? Taxes, accounting staff, rent, sales commissions. Those are the period cost. They're associated not with the manufacturing process, they're the other costs of running your business. Okay? What would be a period cost for Laverne? Their computer services, or lack thereof. What would be a period cost for the University of Laverne? The rent on the building we pay at Vandenberg Air Force Base. That's a period cost. We pay that every year. How many classes we have in that building has nothing to do with the rent. That's a period cost. So it tells you something as a manager about how to take a look at those costs and what they mean to the efficiency or what they tell you about your business. Do you have a lot of fixed costs? Ooh, trouble. If you have a lot of fixed costs, those are costs you have to pay no matter what. Do you have a lot of product costs? Well, that's good, because product costs you pass on to your customers in the selling price. Period costs have to be taken out of the profits you make off the difference between the selling price and the product costs of your business. Very important. And one thing you should ask yourself if you're working for a company, what are you? Are you a variable or a fixed cost in your company? Or are you a product or a period cost in your company? For me, Mr. Hassey, I'm a variable cost and I'm a product cost. Without me, no course, no product. And I'm variable because I put in my hours of working with you students and preparing for class. Whereas your academic advisor would be a fixed cost. Their pay has nothing to do with how many students they see. And it would be a period cost. It's not directly associated with teaching. It's a service of the organization, so it's a period cost is your academic advisor. See how that works? And it tells you something about the company. Okay. 18.1, 18.2 are good examples of these cost classifications. One more thing, and then we're done for the evening. Hey, we lost some people. I scared them away. All right. There's Lisa. Okay, I see her. Now we're going to talk about this a little bit more next week, but I want to go over it now. And again, we have to know the definitions. We do not need to know any accounting entries or anything associated with this, just the definitions. This is chapter 19. It's called job order costing, job costing. What does it cost us to produce a product? A car, an education, a six-pack of beer, a television program, a TV. What does it cost us to provide those services? Why is that important? Who cares how much it costs us? Why? Because if we know how much it costs us, we know how much we got to sell it for. If it cost us $100 to make a product, $80. If we do, we're not going to be in business very long. If it cost us $100, then we know we have to sell it for more than $100 to make a profit to cover our period costs and make a profit. So understanding what it costs us to produce a product is very important. That definition is in chapter 19. It's called managerial accounting. And it goes around three main costs of producing a product. Notice, these are no period costs anywhere in this. It's product costs, materials, labor, overhead. Materials, labor, and overhead. Those are the three costs of producing a product. What type of materials does it take to make your product? What are the overhead or the indirect cost of producing, like factory costs, maintenance on your factory, supervisor salaries? Those are overhead costs. And then labor costs, the actual people who are producing the product. And once all those costs are determined, they go into production. You start building your product. It's called work in process. Once the product is finished, it goes into what is called finished goods inventory. It's ready to be sold. And once it is sold, it becomes a cost of goods sold. We've seen that before. So all these costs go into what is called an asset account, work in process inventory. Once they're finished and completed, they go into another asset account, finished goods. And once they're sold, they become an expense, cost of goods sold. We've seen this process a little bit in retail. In retail, it was all finished goods ready to be sold. You weren't producing it. Here, we're producing it, manufacturing it. But also, this is new in Chapter 19, these 3 types of product cost: materials, labor, and overhead. And we're going to talk about that in a problem, 19.1a, next week at the beginning of class. 19.1a. What are materials, labor, and overhead costs, and how do they filter in and determine our cost of production? Because again, very important. Laverne would not be in operations if we do not know what it cost us per student to give you an education, because that drives the unit charge we charge you in tuition. Ford Motor Company will not be in operation very long if they do not know what it costs them to produce a car, because they have to know what to sell. The revenue or sales price of a car has to cover at least their cost and hopefully more. That's important. So part of managerial accounting is to take that accounting information of all these expenses and all these costs and put them in a system where hey, what's it cost us to make this car? What's it cost us? Notice there's no sales commissions here, no accounting salaries. Those are all period costs. These are all production costs. Here's a slide from the chapter. Production cost or manufacturing costs are raw materials, work in process, finished goods, cost of goods sold. Raw materials go into work in process along with labor and overhead to produce a product that eventually gets sold and becomes an expense. Some of you might have taken for your jobs or will at some time be taking what is called Six Sigma classes. A green belt in Six Sigma, a black belt in Six Sigma. Part of your jobs will be necessitate you to take these courses for your job, and companies usually pay for that. What are Six Sigma and what is green belt, black belt? Their efficiency to make sure this process is done correctly. That's what they are. If you have a black belt in Six Sigma, you are an expert of determining where the production and the costs are in your manufacturing facility. You can track them. You know you're being efficient with that certification that you've been through the black belt course. You know how to determine that. That's a very important job with companies, and you get paid a lot of money with that. Some of you, at some day, if you're going to be in manufacturing or in a business atmosphere with keeping track of efficiency, you'll get a Six Sigma certificate. And part of it is understanding that cost flow that we just talked about. Chapter 19 goes into long, drawn-out things about keeping track of all this, but you do not have to be familiar with that. All you need to know is how this all works and the definitions. So if I go to Cynthia and Blanca and Andrew and say, okay, what are the 3 types of production costs? Mr. Hasse, materials, labor, overhead. Those are the 3 types of production costs. If I go back to chapter 18 that we just did, and I will do that right now. All right. What are materials, labor, and overhead here? Remember, materials, labor, and overhead have to do with product cost. Plastic for casing, materials. Wages of assembly workers, labor. property taxes on the factory, overhead. Drum stands, materials. Annual flat fee for factory maintenance service, overhead. Machinery depreciation, straight line, overhead. This is enough to make your head spin. Variable, fixed, product, period, and all the product costs can be designated materials, labor, overhead. This is one of the nice things, and I know you guys are going to roll your eyes on this, but this is one of the nice things about studying accounting. There's always going to be a need for people in businesses to keep track of all this stuff. Accounting workers are a viable commodity if you're an accounting person. Somebody always needs you to tell whether you're variable or fixed, product or period, materials, labor, or overhead. Notice I didn't classify accounting staff salaries, rent on the equipment for sales staff, upper management salaries, and sales commissions. Those are all period costs that can't be classified as materials, labor, or overhead. But everything else is. Okay? That's an important designation, and they define those in Chapter 19. You're going to have a problem on your exam where I'm going to give you a list of these costs, and I'm going to give you two other columns: variable, fixed, product, period, materials, labor, or overhead. Now, for the period cost, you would leave that blank. But for the product cost, you would have to determine materials, labor, overhead. Materials, overhead, overhead. So just be aware of that for future endeavors, and I will show this to you in an outline that I give you next week on Sunday. Okay, next week we're going to take a look at a problem that we just talked about, materials, labor, and overhead, 19.1a. And we're going to look at Chapter 21. And where Chapter 21 is important is it's called cost volume. Concentrate in your reading in Chapter 21 on the definition of the break-even point. How many units do we have to sell to make a profit? I'll give you an example. At the University of Laverne, if we have 10 students in a class, our costs are covered. If we have 10 students in a class, our costs are covered. If we have 9 students in a class, we're losing money. If we have 11 students in a class, we're making a profit. 12 students, profit. It's the relationship of fixed and variable that can give us this information. It's called the break-even point. And we're going to learn that analysis, which will be very important when you come to your business finance class, whenever you have it. Matter of fact, all this leads into that class. So we'll cover Chapter 19.1 next week, and we'll look at Chapter 21, the definition of cost volume analysis. We'll have a review of the final next week in class. As you know, I've recorded the session for this evening. Does anybody have any final questions before I send you off into the real world of managerial accounting? Isn't the nice thing about this is, I know you're probably gonna like, what? I don't know what he's talking about. But the nice thing about this, did we talk about one journal entry tonight? No. Did we talk about any closing of the books or putting together these stupid financial statements? No. We talked about stuff that, oh, you know, we always get these budget reports in our department. I never know what the hell those mean. managerial accounting. Oh, they're always talking about adding new employees or moving employees around or cutting staff or whatever. Who makes those decisions and how they do that? Who just signed off? How dare they? How did they make those decisions? Well, because they know the definitions of whether you're a variable or a fixed cost, whether you're a product or a period cost. Now you know why. Any questions from any of you, please? All right, I'll have your quiz grades up by the weekend with solutions. If you have any questions or concerns, I'll see you in our office hours next week, or you can text me or email me your concerns. If not, I'll see you next Wednesday with our final regular class on chapter 21 and a review of our final, and we begin the process of closing our summer. Yes, I'll have to bring some Kleenex next week. I'll have a little bit of a tear in my eye as we wind things down. I will never see you again, probably, unless you are sick enough to take me in business finance. What? Why? Don't, please, no. So remember that. Remember your course evaluations, and please post to the discussion forum, Jessica, your recipe for lasagna. That would be a nice little hint or a nice little thing for the class. Post your recipe for lasagna. Lisa, I want you to post your recipe for a good margarita, because we'll take the margarita and we'll eat it and drink it with the lasagna. What? You
I don't drink. I don't drink.
Even after taking 8 weeks of accounting, you're still not drinking? That's good for you. You're commended. Good job, Lisa. After 8 weeks of teaching you guys, I'm going to about ready to have a margarita tonight. All right, we shouldn't talk about that. That's not nice. Okay. Thanks, everybody. We'll see you next week. Adios. Get out. Leave. I don't want to see you anymore. Bye.
Bye.
Bye, Michelle.
Good night.
Night, everybody. Be careful. Be well. Mask. Vote. Bye, Cynthia. I'm going to...
Bye.
Cynthia, I'm going to hack into your computer later on tonight, so be ready.
No!
Bye-bye. Blanca, make your bed for Pete's sakes. Good night.
Good night. Thank you.
No, I am not teaching statistics next term, Lisa. They asked me about that, and I just don't have the schedule to do it. I apologize. I might teach it in the spring or the winter,
Okay.
but that's still undecided. But no, I'm not, Lisa. I can't fit it into my schedule. I apologize.
Oh, no problem. But thank you. Thank you for
Okay.
answering. Good
All
night.
right. See ya. Good night. Lakers winning? No. Down. Damn. Adios.